Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long short report covering all asset classes.
Now it's important to have a discussion on Bank Nifty, especially since it's been the center of all the distraction. And the reason for that is that it's been an underperforming sector. Possibly it can remain that way, but in the near term, it seems to have picked up momentum. So we'll look at what exactly happened, or what is keeping it back, and what is going to drive it ahead from a technical perspective. Now, the entire decline that you see in Bank Nifty, and it's really important how you mark this entire sell-off that we've seen from the January top, or rather I should say, yes, early January is where the Bank Nifty peaked much ahead of the Nifty itself. So there was an intermarket divergence right at the peak, an important indicator that banks or financials were not continuing to perform in terms of, making new highs, confirming what the Nifty was doing. So when the Nifty actually made a higher high around the 20th of the month, Bank Nifty was actually making a lower top and heading lower. So what it ended up doing in terms of wave count is, when you look at the very, very short term, this was actually a small little 5-wave decline that we ended up getting here. Okay, and that was the first sign that possibly something actually changed. So we start by marking that 5-wave decline as wave A of a larger sell-off. Okay, and then we mark this bounce back as B. And what we get subsequent to that is again another 5-wave decline. Okay, so this is what ended up happening. This fourth is essentially a sideways triangle or complex pattern, and then you get a fifth wave. So this initial ABC decline, which is just ahead or right after the budget announcements, and then you got the bounce into Feb from where the big sell-off occurred. So this can be marked as ABCX, and then this entire big sell-off ends up being broadly wave Y. So this is an important thing to really understand, because when you mark ABC, which means it is a zigzag, but doesn't get followed up by another impulsive move, means ABC completed but the bearish trend was not complete. What we usually do is we mark that as W. So that's what we call as a complex correction. It's the purpose of a complex correction or marking is that ABC was not enough to correct the market, and therefore it's going to extend. And to simplify our markings, we mark each ABC down as W and each bounce back from that as an X. So that's the simple thing. And so instead of ABCX, ABC, we end up calling it WX, Y, X, and Z. Now note what's happening over here is that Z is actually a higher bottom than the point Y. Now when do we really get an reversal in the market is when you actually get an impulsive advance. So if you have seen my Elliott Wave Basics video, what you'd on YouTube, you'd know is that 5 waves in the direction of the main trend is what you get. So if the main trend is down, then everything moves in 5 waves down, which is what we saw right at the start of January. Bank Nifty started to move in 5 waves down, bounce, 5 waves down, bounce, and that's an indication. The first 5 wave itself is the warning, and then you get the subsequent indication from the lower high that you're overall in a downward trend. Similarly, how does this downward trend really end? It ends when you get a upward 5 waves. So till you don't get an upward 5 waves, you're trying to anticipate that you've reached the end based on either your Elliott Wave readings or on your understanding of market sentiment. But what ended up happening from the bounce from March to May, when the Nifty actually retraced much more significantly of its decline, Bank Nifty ended up forming something that looks more like a triangular pattern. So it didn't form a perfectly impulsive rally. It looks slightly corrective, and what I've ended up taking that is an X wave. And this last sell-off into the month of May, where the Nifty only did a 38% retracement of that rise, Bank Nifty ended up doing an almost 78% retracement. So I've marked that as the final bottom point in terms of wave Z. There's also another reason for that many of the individual stocks within banking or financials, to take names, things like State Bank of India or Bajaj Finance and so on, many of these financials were actually falling to new lows in the month of May. Now there were a few that weren't, maybe large caps like Kotak and others, which held up the index from going to a new low. but many of them did end up falling to new lows, including maybe RBL Bank and so on, which are in the Bank Nifty because the Bajaj companies are not in Bank Nifty. And so the point being that the actual orthodox bottom, what we call the final bottom when it doesn't make a lower low, ended up happening here where most of the financial sector actually made its bottom. So this marking is important, that this ends up being Z. This rises, therefore I have not taken it as A and B. And if this is Z and this is the end point, then what we ended up getting from there is the actual first impulsive wave or rally in Bank Nifty. Now, of course, it's moved much more slowly, which is why it's also lagging the Nifty in general. Even though the trend is up, it's tending to lag, and that's a longer term issue that we can face if the financial sector does the same thing like the global financial sector did post 2009 after their financial crisis. So the burden fell, of course, on banks, and then while they've gone up after that, they've gone up by a smaller percentage than maybe the Dow index itself or the S&P index itself. So that's a separate issue, more longer term. But if you have a market heading higher, then you can't really have the financials going the other way. So that's the important idea. So you cannot have the opposite trend. You can just have slower pace. And what we ended up getting here, therefore, was the initial 5-wave move. Okay, and this 5-wave move is an overlapping 5 waves, which is not normal. Most people say, well, the fourth wave's fallen into the territory of wave 1. So is it really possible to mark this as 5 waves? The only time it's possible is that you can certainly mark each of these rallies as 5-wave moves, which means each of them are smaller degree impulses, which means even the third wave itself is a 5-wave rally. And if that is the case and it is overlapping, then we call that a leading diagonal, right? So what we have here is essentially a leading diagonal, in my opinion, and this leading diagonal is therefore wave 1 overall. So this whole 5-wave advance is wave 1. You have a small little ABC correction over here, which is wave 2, and what we are doing now is kicking off into a third wave rally. So it took time again because you've seen the Nifty consolidate below the 11,400 mark. You have a big gap left behind. On the 28th of February, the market actually gapped down. That's when it broke the low that it had made after the budget and then bounced after that. And that low actually broke, signaling that a larger sell-off was starting. So that happened with a 100-point gap below 11,536 all the way to 11,433. So that's the resistance zone below which the Nifty was trading all of August. And it needed that push from some other sector or segment, and banking, which was lagging behind, was an important one to really join the move up into the next leg. It's taken its own sweet time, and while it's been doing this rounding type of bottom over here, what the Nifty's ended up doing is consolidating below that gap zone. Now today we've closed inside that gap zone. The Nifty is trying to fill it and break out of it, and at least it's broken past the highs that it has made all of last month. And in that sense, I believe this marks the start of the larger third wave advance. In short, what I'm saying is that banking is going to be one of the performing sectors for the month in the near term, may become an important driver for the Nifty also to higher highs. And so this is probably the thing to watch out for in the coming weeks, is how financials end up doing. Many of them were showing some strength and momentum, at least some of the large ones. We've seen that today. And overall, this third wave can stretch quite a bit. If we use a channel or we use multiple retracements, we can come up with several levels that we can actually end up testing, because you can argue, is this wave 1 or wave A? It's in early stages. Is this wave 2 or B? And even if you take it as an ABC and you're looking for a 61% retracement, you will end up at 25,762. So that's going to be the first thing to watch, and that's also very close to this gap area. So around the 13th of March, we made a high of 25,670, which is just tried to fill the gap it had left behind 3 days ago, but it didn't completely close that gap. So the gap that's still left behind there is just around the 61% mark, and so I think that's going to be the first resistance we go and test. And then we look at, if we get past that, we look at what this larger setup can actually end up telling us about where this is headed. So within the financials, while everyone can remain focused on, of course, the private banks and so on, an interesting space is always the PSU banks, while they've been in a longer term bear market, whenever you get bounce backs in bear markets, you get pretty sharp moves. So I was actually looking at the setup and what can happen over here. I've already written about it, I think, and shared it online, but to just go over it, what happened in the last phase of this sell-off, and see this index too continued to fall into the end of May, exactly what I was saying, where I've marked the end for the Bank Nifty in terms of wave Z being truncated or being an orthodox bottom. Because this is where the financials bottomed. You ended up with an ending diagonal right at the end of this move. So initially it looked like maybe this triangle could lead us to a bottoming formation. But then when this triangle broke, I had to change the structure, and it's ended up being an ending diagonal on the way down. And this ending diagonal completes the overall decline that we saw in the previous wave, which I'm actually marking as wave Y of the longer term bear market. So what I actually expect here is that you'll end up getting an ABC move up, whether I mark A and B here, or more probably mark it into this high, which means this entire rise would be a 5-wave rise with the initial minor wave 1, minor wave 2, 3 and 4 and 5. So where we are then is we've been consolidating in wave B. Wave B could have been a simple ABC decline right to this bottom. Then it ended up forming a triangle, then it's had some more zigzag movement. So it gets a little more complex, but that doesn't change. Just because it's taken time, it doesn't change the idea that we are in wave B. In a worst case scenario, if this does become a broader triangle, you are doing A, B, C, D, and what you'll end up getting is wave E to the downside. So I don't know if that will happen. You've actually pushed slightly above this upper line. But again, the triangle formations always start from the second high, usually logically. So if this has to switch upward slightly, maybe we can actually look at that kind of an adjustment. But yes, it won't have a perfect look of a triangle if that happens. So I would think that wave B is probably complete as a complex pattern at this point of time, which is what the setup is, which means market as W and X, and not really expected to finally become a triangle. So if wave C up has itself really started, what we start looking for is whether wave C can be as big as wave A itself, and whether it will go ahead all the way to the top end of the next channel. So that's how I usually project these moves. You expect at least equality between A and C. Of course, it can be truncated or it can be extended. Will it go back to the previous high? What will it be in terms of a retracement? Now, if it's an ABC, what I'm broadly saying is that this is an X wave. It's probably not the start of a complete turnaround in the sector, but what it does give you is a significant move. So if you take the previous high, we've actually broken out of this channel. I mean, we've broken down on this channel structure, so that's not relevant. I think the only relevant thing that you do if you look for an X wave is look for a meaningful retracement of the last segment of the decline. Okay, so if this is a larger ABC that we had in terms of this sell-off, or if we take it from here, then what we are looking at, even if you get a 38% retracement of this move, then the index ends up at around 2,330 odd, which is quite significant. So I'm not even thinking 50%, which would be closer to this swing high. In both cases, it would be significant in terms of an X wave, but that also means that wave C would have to subdivide into a much larger 5-wave advance if it has to go there. Now again, not necessary. We see how it progresses. The main thing is that wave C has to be a 5-wave move in corrective structures, irrespective of whether it's a flat or a zigzag. And wherever 5 waves complete, whether it's at equality, whether it's at the channels, or whether it continues to the higher retracements, is something we'll have to figure out along the way as the structure continues to develop. But we do know that wave C is just starting off, and therefore there's a lot more room for it to move on the upward side.